Hello everyone and welcome to this latest Trade Zone presented by Eightcap. My name is Stuart McPhee and it's my pleasure to be here with you on this Monday, the 20th of June. Happy Monday to everybody. I'm coming to you from Melbourne, Australia. So my Monday's almost over, having just ticked over 7 o'clock on Monday evening. But a very warm welcome to you wherever you are listening in the world. It's great to have your company. So in this session, and certainly a welcome back to those who have joined me for the last few sessions last week and the week before. So like I've done previously, what I'm going to do for my session today is I'm just going to run through another little topic for some education to help you with your trading plan and getting that trading plan you want and something you're going to have some confidence in. Run through a little bit of PowerPoint stuff, some theory on risk management today. And then the second half of my time with you today, we're going to go and look at some charts. I want to just focus in on the ASX 200 and have a little bit of a deeper dig into that index and the constituents and the stocks in there, and just talk about some of the things that I look at when I'm looking at equities, specifically Australian equities. We'll also go through some currency pairs as well. We have obviously looked at some of those the last 2 weeks or so, and we'll just revisit those and see where they've gone since I spoke to you last time. Let's get into the PowerPoint now. And as I said, we'll just go through some education. So here's my presentation for today, and we'll get going. So I've mentioned to you this before, and it's one of those things that I think you cannot overstate, and it's really important. And if you've heard this 500 times, you're going to hear it 501 times. And I think, again, that's probably not enough. You really need to convince yourself of the importance of having a trading plan. And that trading plan suits you, it's right for you, it suits your risk profile. And then you need to prepare yourself mentally to execute that plan, to implement that plan with the right mindset, the right mental approach, the right attitude, the right discipline, decisiveness, confidence, conviction, all that patience, all those other things that we can talk about. That's the real key. And I've mentioned the 3 M's there, the money, method, and mindset. And what I'm going to talk about specifically in this session, just for a few minutes, obviously in the first half of this session, is just I want to focus a little bit more on the money side of things. And that's, how we manage our exposure to risk and how we manage our money. So that's what I'd like to talk about now. Well, if we forget about the mindset just for a second, everything you do with managing risk is important, is really, really important. It's vital. I'll go as far as saying it's paramount. It's number one. So if you think about the 3 decisions you routinely make as a trader, you decide to enter trades, how much money do you commit to those trades, and how do you get out of those trades? 2 of those 3 questions relate to managing risk. How we size our trades, how much of our capital is going into individual trades, and how we get out of those trades relate to risk management. I would also argue that in terms of importance, they're actually the opposite of the way most people talk about them. We all talk about entry, how big is our trade, and how do we get out? So far as importance is concerned, they're actually the opposite. How we get out is number one, closely followed by how big our trades are, how we size our trades, and a distant third is how we get into trades. But it's counterintuitive to think that. If you talk to a trader that's just started and you say, your decision to get out of trades is really, really important, they'll go, that's ridiculous. How can you suggest something so stupid? Clearly, your decision to enter trades is going to determine whether you make money or not. No, it's not. It's just not. And the sooner you convince yourself of that, the better off you'll be. So the mindset aside, from a decision-making standpoint, your decisions related to trading, I cannot overstate that. A poor entry can be saved by a good exit. A poor entry can be saved by a good exit. So if we get into a trade for no reason whatsoever other than just let's have a trade, and this trade just goes wrong in all sorts of ways, we can save it. We can save it by just getting out at an appropriate time, cutting that loss, getting out of the trade and moving on to the next trade. But I'll also say the opposite. A really, really good entry into a trade for all the right reasons and all the analysis, all your criteria were met. So a really, really good entry can be completely ruined by a poor exit. Right, so the exiting is incredible. I'll say that again. A really, really good entry can be completely ruined by a poor exit. I cannot overstate the importance of exiting trades and managing those exits. And, again, all those things related to managing risk. I'll talk about 8.2 and 2.8 in just a moment. I have a little graphic I'd like to share with you. And again, you've probably seen something similar before. But again, I think it's important that you just need to be reminded of these things. And it's easy for us to drift away. And, we hear Stuart talking tonight and he says something and you say to yourself, that makes a lot of sense. I agree with him and I've heard that before. And then we forget about it and we don't implement that into our trading. And then 1 month later, someone else in my seat in the trade zone comes in and goes, oh, you should be doing this with managing risk. And you go, yeah, I think that's a really good idea. I agree with that. In fact, I've heard that before, but I still haven't done anything about it. So sometimes I think you can't hear some things too many times and you just need to be reminding yourself all the time. I want to talk about key performance numbers just quickly. Key performance number. I talk about 4 key performance numbers that you need to know from your trading and need to keep on top of and manage. Those key performance numbers are your percentage of winning trades, your percentage of profitable trades, your percentage of losing trades, your average profit, and your average loss. And the first number I mentioned then, or the first item I mentioned, is percentage of winning trades. So many people focus on percentage of winning trades. I must get the highest number possible. I must strive to get 80%, 90%, 85, 75. I'm telling you from experience, achieving a strike rate of 80% or near that is as close to impossible as you can get. Yet people have this ambition and this idea that, well, I need to get 80%. The more percentage of my trades that are profitable, clearly the more money I'm going to make and the more opportunity I have to make money. Again, not necessarily the case at all. And again, a lot of these things can be counterintuitive, but this whole part of managing risk is all about managing our capital allocation, position sizing, managing our exits and the like. But again, it's that whole idea of average loss versus average profit. And as I've said to many people over the years, and I'll say to you now, it's not how often you get it right and get it wrong. It's what happens when you get it right and get it wrong. Okay, so it's not what happens, it's not how often you have profitable trades and how often you have losing trades. It's what happens when you have a profitable trade and what happens when you have a losing trade. And I think 2 of the most important time-tested trading rules of the 8 that I talk to people about. Number 1 is cutting your losses, which I would argue anybody to come up with a more important time-tested trading rule than that, cutting your losing trades. And the other one, depending on your trading style, it's not applicable to everybody, but letting your profits run, extracting the maximum you can out of your profitable trades to ensure that your average profit is in fact significantly greater than your average loss. And people are often talk about, oh, you'll never go broke, you'll never lose money taking a profit. If you have a profitable trade right now and you close it you'll never lose money that way. That's the problem. That's how a lot of people do lose money. They take lots of profitable trades, but their average profit, their average, is quite small and it does not outnumber or outweigh or balance out all the losses that they take at the same time. You never lose money taking a profit. I don't agree. That's exactly how a lot of traders do lose money. Just show you this simple graphic. Again, just to try to, I guess, debunk, demystify, just try to, those misconceptions that people have, the myths that people have about, percentage of winning trades, percentage of losing trades and the like. And all I've got here is a very simple example, very simple series of purely simulated results. And what we have here in this table are the results of 10 trades. And you'll notice them numbered down the bottom here, 1 through to 10. In the middle here, the green bars, represent the either profit or loss in that trade. Up the top here, with a starting balance of $20,000, the black line with the red squares indicates our account balance after each trade. So after trade 1, I can tell you now trade 1 makes a 10% profit. So our account balance after trade 1 goes from 20,000 to 22,000. Well, fortunately for us, trades number 2, 3, and 4 all make money, all make a further 10%. And you can see our account balance has grown to almost a 50% gain after 4 trades, after 4 winning trades in a row. The 5th trade is a losing trade, and you can see by the bar how much that trade lost. Unfortunately, that trade, one trade, lost 50% of the account. So you can see our account balance reflects accordingly. However, we turned it around, and that trade 6, 7, 8, and 9 also made a profit, and they all made a 10% gain. However, trade 10 was a further 50% loss. You're with me so far, right? We've had 10 simulated trades. 8 of those trades have been profitable. Only 2 have been losses. 80% strike rate is extraordinary. As I mentioned, almost impossible to achieve. I'm sure there's someone out there that has a strike rate of 80%. It is a very rare case. So it's certainly the exception to the rule. So we've had a strike rate here of 80%. Imagine if you told a new trader or someone with limited experience, hey, I can give you a system, 80% of your trades will be profitable. You will think, how much money am I about to make? And yet, this person here, after their 10 trades, is lucky to have half their money left. Yet, 80% of their trades have been profitable. This simple example illustrates the importance of it's not how often you get it right or how often you get it wrong, right? How often you have a profit, how often you have a loss. It's what happens when you have a profit and what happens when you have a loss. See trade number 5 there. Anybody who has traded has experienced a loss that just got out of hand. That was just horrible, just well beyond what we could imagine, and it just continued to go against us. And we didn't know what to do, and we buried our head in the sand, and we just went crazy over it. We have all experienced at least one of those trades. I can tell you from experience, the sooner you can eliminate that from your trading, the better off you'll be. You must do everything in your power to eliminate that possibility. You must. I implore you to eliminate those sort of trades from your trading. The sooner you do, the better off you'll be. So again, just a simple illustration of almost the irrelevance of strike rate. Yet so many people focus on, I must get a high strike rate. And, if I was to say to you, and I can tell you now with my currency trading, 41, 42% strike rate. And, imagine me telling a beginner trader, or someone asking me in the audience, hey, Stuart, what's your strike rate? What's your percentage of winning trades? I'll go, 42%. They'll go, what? That's ridiculous. How can you make money? I thought you were a good trader. And yet only 40% of your trades make money. It's just really not that important. And 50% is actually really quite good. And you go beyond that to 60, 70, we're talking now excellent, brilliant, almost out of reach to achieve a strike rate of that. So it's very easy for people to, be a little bit disorientated with that, I guess, and a little bit led down the wrong path. I love this quote. Paul Tudor Jones was one of the traders interviewed in the original Market Wizards book by Jack Schwager. If you only ever read one trading book, yes, of course, I'd like it to be mine, but forget that. If you only ever read one trading book, I think it should be Market Wizards by Jack Schwager. It is just outstanding. Interviews with about 20 odd people, and this is one of the people. And his track record is phenomenal, and the advice is so simple. Don't focus on making money. Focus on protecting what you have. And, when I talk live and I'll say to people, why are we doing this? Why are you here in front of me now listening to me speak? Why are you here in this session now? And I say it's nothing to be ashamed of. For most people, it's money. We are driven by, we want to make money out of this. And that's perfectly fine. Nothing to be ashamed of. In fact, we are surrounded by people in that same situation. And here's this guy's advice. No, forget that. Don't focus on making money. Completely reverse. Focus on protecting what you have. So rather than attack, aggressive, optimistic, ambitious, let's make lots of money, really aggressive, it's the opposite. It's let's be defensive, conservative, be very protective, not aggressive, actually quite conservative. Don't focus on making money. Focus on protecting what you have. Another quote from another trader interviewed in the same book, and I love this. The elements of good trading, there's 3 of them. And there's the three there, right? The elements of good trading are those three things. If you can follow these three rules, you may have a chance. That's how important he believes those three things are. That's how important he believes cutting losses are. And I really enjoy this quote as well. And I'm going to read over it. Learn to take losses. The most important thing in making money has nothing to do with your profitable trades. Nothing to do with your profitable trades. The most important thing in making money is not letting your losses get out of hand, right? Eliminate that from your game. Well, this is a topic that I could talk for hours on. We could talk about position sizing models and how to size your trades. We could talk about how to set stops. I use a volatility-based stop-loss model, often using average true range. We could talk about that at great length, but we won't. I just need to finish up on this, and then we're going to have a look at some charts. I mentioned cutting your losses and letting your profits run being two of my most important time-tested trading rules. This is actually another one. And I just wanted to finish with this because I think it's related to risk management. Don't overtrade, right? Don't force the action. Don't force trades. It's counterintuitive to think about not overtrading. Because why are we doing this? Well, we're doing this to make money. How do we make money? We get into trades. Then we think, okay, clearly the more trades we get into, the more opportunity we are giving ourselves to make money. Make sense? Yes? So it's easy to think that. And then I come along and say, no, you need to undertrade, right? Undertrade, trade less than you think. And you go, oh, no. How's that giving me opportunities to make money? I need to get into lots of trades. It's counterintuitive when I tell you don't overtrade. Don't force the action. I tell people all the time, demand quality of trading opportunities, not quantity of trading opportunities. Quality, high probability, low risk, not low probability, high risk. And finally, let your trading plan do its job. If your trading plan says, Stuart, no trading opportunities today, that is the correct answer. That's the right answer. Your trading plan is saying there's no opportunities today. None have met your criterion. Go and do something else. Come back tomorrow. Come back in 4 hours, whatever your time frame might be. Okay, let's go and have a look at some charts. Going to MT4 first as I move on to the second half of this presentation. Hopefully you can all see that okay, nice and clearly. Look, I just wanted to talk about the ASX 200, and we've spoken about indices a fair bit of late. I'm just going to whack this around 7,600. That's not exactly where it should be, and then around 7,000 or thereabouts. Pretty close, because I've noticed that's been, pretty significant levels over the last little while. But like a lot of equity markets, it's not had a good last few weeks. So it's actually smashed through any sort of semblance of support there at that $7,000 level. Sorry, 7,000 level, moving down to what is now close to 2-year lows. I just wanted to delve into this a little bit more because I do trade equities, Australian equities. I do it in my retirement fund. So it's a lot more conservative, a lot more medium term. But I just wanted to share with you one or two tools that I use that I sort of I didn't come up with them. I just sort of thought about them, or someone mentioned to them and I incorporated them into my software. And just like my session last week, I'm not here to sell you software. So I'm not even going to mention the name of the software, nor do I even want you to look. So please don't. Let's just focus on the chart. One of the things that I do want to share with you before we start is this is actually a chart of the S&P ASX 200, which is what the Australian 200 index with Eightcap is actually based on, the ASX 200. So this is a broad brush market index tracking the top 200 stocks within Australia. And it would be a very similar picture to many other equity indices around the world. So we've got similar levels, 7,000 and 7,600. And just of late, we've seen this decline. Now, what you'll also notice on this chart is another tool that I use. And this tool is called the Advanced Decline Line. Now, I'm not the guy who invented this, or girl. This has been talked about for a long time. You can go and look it up yourself, do your own research. But an advanced decline line. And what an advanced decline line does, let me backtrack. Let's talk about what an index does. Most indices are weighted. Therefore, the larger the company, the more of an influence it has on the calculation of that index. So in this particular case, the top 20 stocks, and I don't know the exact number, but the top 20 stocks out of 200 would influence the value of this index by about 80, 85, 90%. Whereas the remaining 180 have next to no influence on the value of this index, even though they are constituents. even though they are part of that index, they just have next to no weighting, next to no influence on the value of the index. If the top 20 stocks go up for the day and the remaining 180 go down, this index will go up. It's that simple. So what it's doing is it's a little bit skewed in that sense. And this has been the case for years before I got into the markets. But what the advanced decline line does is it looks a little bit deeper and it says, I don't care how big you are as a company. I don't care. All I'm going to do is of those 200 stocks, every day I'm going to count how many increased in value, how many remain unchanged, and how many decreased in value. And therefore, how many advanced and how many declined, the advanced decline line. And all it does at the end of every day is just either adds, if there's more advances than decliners, it will add the difference. And if there's more decliners, more that went down than went up, it will it will subtract the difference. And this is where it can be really, really interesting. What you'll find is the black line, the advanced decline line, typically will follow the index. It's very, very common. I can zoom out and show you almost all the history, and whatever shape the index takes, pretty much that's what the black line takes. Every now and again, and we'll just zoom in a little bit, every now and again, it does something a little bit different, and that's the key. That's what I'm looking for. And what we'll notice here, for example, and I'll just draw some lines in here, what we'll notice here is the peak of the black line, and this is the next peak of the black line, just like that. And sure enough, the index did exactly the same thing. That's fine, right? And then sure enough, the stocks fall and the black line falls, goes back up, black line goes up, and then it falls sharply and the black line goes down. But what we notice is right here, this blue line across the top here, the value of the index reached a very similar level to where it was at the beginning of the year, several months ago. However, the black line didn't. And what that's telling me is even though the market returned to its previous level, most of the stocks were not reflecting that. In fact, quite a few of the stocks were struggling, and it was less stocks pushing up the index back to those previous highs. Most of the stocks were. So it just gives me a little bit more of a deeper look into what is going on within the market. And again, do your own reading on that. There's a lot to be read about advanced decline line and accessing that and interpreting it. But as I said, it doesn't provide an indication very often at all. Most times, and I mean 360 days out of 365, not that we trade every day, but you get the point that it pretty much follows the index. It's when it doesn't, that's when an alarm bell goes off. What I also wanted to share with you is just quickly do a quick few market scans, real quick. So what I'm going to do here is find out all the stocks, and we'll go to the All Ordinaries Index, which in Australia is the top 500 companies. And we'll just do a quick scan to find out all the stocks in the top 500, so all pretty big companies, that have achieved an all-time high in the last week. All-time high in the last week. And it's a big, fat zero. Any surprise? I didn't think so. Big, fat zero. Let's go and check all the stocks in the same group, top 500, that have achieved an all-time low in the last week. And it's not a big, fat zero. I'm pretty confident of that. It is, in fact, go for it, there, 11. So not 0, but 11. So, and then if I went, excuse me, and what's this, all-time low? Yeah, weekly, 11. If I then went and said, okay, well, forget about all-time, let's just go 12-month. Top 500 companies, 12-month low, not all-time. We know the index is near 2-year lows. How many stocks out of the top 500 are currently at a 12-month low? It won't be 0, and it is, in fact, just waiting for that number to pop up. Now you can do it. It's 66. 66. So it's what, about 13% of the market have achieved a 12-month low within the last week. If I went back the week before, it'd be a whole new bunch, plus probably some that are here. If we go next week, who knows? What am I getting at here? What I'm doing, and we'll come back to the indexes. So what I'm doing here is I'm just digging a little bit deeper into the numbers. And what I do is actually, sometimes out of morbid curiosity, once a week, I'll do what I just did then. I will track how many stocks have achieved a 12-month high, 12-month low, all-time high, all-time low. It does two things. Number one, it gives me a bit of a feel about stocks that are not highlighted, stocks that are not top 20, not top 50. Some of the other stocks, it's just giving me a bit more of a deeper look into what's going on in the market. If we have equal, all-time high, all-time low, that's okay. If there's 10 times as many achieving all-time low, or there's none achieving an all-time high or a 12-month high, that tells me something. I see it in the index, I know that, but it just helps me, I guess, support the picture that I'm seeing in the index, and it almost validates what I'm seeing in the index, because sometimes the index can provide just a slightly distorted view, which I'm not proud to admit that's the case, but I think it can do that. The other thing it can do is, because with my equity trading, I like buying things at highs, I like finding stocks that are trading at either all-time highs or 12-month highs. Do you know why? There's a reason why they're trading at all-time highs or 12-month highs. Something's going on. A lot of people like it. Well, all of a sudden now I am interested and I like it. There's a reason why stocks trade at all-time highs. There's also a reason why stocks trade at all-time lows, and that's because a lot of people don't want them. Let's go and have a look at some currency pairs real quickly before my time today ends with you. We've looked at the euro, US a fair bit, and rightly so. It is certainly the most actively traded currency pair that we have. And I did mention, whilst it was trading near sort of multi-year lows here, and it had been sort of trading around this 107.50 level, which certainly initially provided a measure of support, and then certainly for a good several weeks here. And several weeks in currency land is a lot of time. It's a lot of trading. It's 24 hours a day, 5 days a week. There is a lot of activity and a lot of money going through. So for that level to stand tall like that, stand firm, and just repel advances, repel buys, and just keep really significant downward pressure on price is pretty significant. And then we've seen the Euro-US fall away. And I said it to you last week or the week before. I said I wouldn't be at all surprised if it actually came down to this level here and found a bit of support right here. Why did I say that? Well, there's a lot of levels where it turns and you can say, oh, next time it comes down, it'll bounce off that level. But it doesn't often happen that way. For example, here it's found the low, come back down, bounced off a little bit, but kept going. Here's another low. Next time it came down there, it went lower. Next time it came down to this level, it kept going. Next time it came down to this level, it kept going. So it's not always that, well, it got to that level 2 weeks ago and bounced off, it's going to do it again. But I didn't indicate it probably would happen this time. That's because of the significance of that low. All of these are really not that significant because there's previous price activity back here. But the fact that this is now, let me just zoom out a little bit for perspective. We're talking about now, it's the lowest point in 6 years. It's also, I've drawn this in for a reason, also the last time it got down to this low, it bounced off pretty significantly. And sure enough, it's right back there again at that level. So again, I just think it had more likelihood. Remember, all of this analysis is all about probability. I believe it just had a greater chance of moving down to this level again and bouncing off. And sure enough, that's exactly what it did. The significance from 6 years ago, but then it's been reinforced by the recent low here. And then again, it's now been even more reinforced. So imagine the sentiment if it rolled over again, tested this level again, and then actually dropped below and then remained below. Imagine how significant that would be and how many people would be jumping all over that to short it, to sell it, to push it down to parity, push it down to 1. Can you believe that? I also identified this level right around 106, where again, just, a bit of resistance here, traded through, but got sold back off again. And then sort of 1, 2, 3, 4 days in a row. This is over the course of a week and a half now, pushing up against 106, just can't get through. Comes up again. 1 day, 2 days in a row, pushes up against 106, just can't get through. Sort of came down to 106 here, bounced off, and it's revisited that 106 level again and been sold off again. So that's why I've just drawn in that line there. Notice it's not as bold. I'm just sort of saying, yeah, it's a bit of resistance in there, no doubt, bit of significance. But the more significant level is down where we're seeing down with this level here. Excuse me, much more significant. Again, because of that multi-year low, the fact that it sort of rallied very strongly here and it's just retested and bounced off again. I use the word significant all the time when I talk about key levels and support and resistance because that's what they are. They are levels of significance. Similarly with the Australian dollar, I'll just zoom out again. We're talking about this 70-cent level, and where it got to just recently is, a 2-year low. That's significant, 2-year low. So sure enough, when it got sold off as heavily again, it got down to this same level and bounced off again. You could almost remove the scale and put the scale in for the euro, couldn't you? And it's almost a similar picture where it's hit this multi-year low, traded off, come down again and tested that level again and bounced off and now starting to roll over. The significance again is if it comes down to that level, what does it do? Does it bounce off again, find some support, or does it drop through for good? You know, just knowing how long the Australian dollar has spent between sort of 70 and 75, I'll be all surprised if it actually gets back in. And, you know, there's a big difference, I think, with the Australian dollar with a 6 in front of the price compared to a 7. Massive difference. And sure enough, right now, we're just below that 7 now into the 6s, and that's significant, again, using that word again. So that's it. I just wanted to share with you, sure enough, we looked at some currency pairs and the like, but I just wanted to share with you a little bit about some of the equity stuff that I do. I mean, equities is where I started. I do a lot of analysis there, a lot of number crunching, because obviously, you know, currency pairs, there might only be 8 or 10 or 12, but when it comes to equities, there's going to be 500 or thereabouts. So there's a lot more number crunching involved. So I just wanted to share with you, just in the limited time I have in these sessions, just a quick insight into some of the things that I do. And I hope that's provided you some food for thought and hopefully something you can take away and do your own research on and prove or disprove or incorporate into your own trading. Well, that's it for this session. Again, thank you very much for your time. It's been my pleasure to be with you here on this Monday. Reminder again, I'll be back again in 48 hours' time on Wednesday to do another Trade Zone session. We'll go through a little bit more education, this time on the psychology of trading. And sure enough, we'll go ahead and look at some more charts again as well. And I look forward to seeing you then. Thanks very much.